think this is a time when appreciation plays are under a lot of stress. The major indexes in equities and bonds are all down year to date. And I think this is a time when income strategies are much better ideas than trying to make money through appreciation.
Income strategies like what?
Well, I've invented a strategy, an income strategy, and I use exchange-traded funds, closed-end funds, exchange-traded notes, one REIT, and all of it's yielding over 10%, Becky, which outpaces our rate of inflation, which I calculate well over 9% if you take the CPI and the PPI. And consequently, if you can get over 10%, and it's also paying money every single month. So every single month you get cash, and then you can decide what to do with it if you need it for your living expenses, or a pension fund needs it to pay its liabilities, but you have cash and you get to make the decision. And I think that's a far better strategy for this moment than trying to better speculate on that something is going to go up.
We have seen a lot of damage to the markets this year, but you're thinking that it's not enough to reflect what's coming from the Fed at this point. You say Newton's third law of motion has kicked into play. I guess that's the law that for every action, there's an equal and opposite reaction. What do you think is playing out here?
Yeah, the Fed is going to be raising interest rates. They've made it clear they're going to be raising interest rates. They're also cutting back now in their portfolio. And that's very significant because they've been the biggest buyer in the fixed income markets, both the treasuries and mortgage-backed securities. And that's also going to have a major effect on the equity markets. And the reason is that the cost of borrowing is going to go up significantly, which means there'll be fewer stock buybacks. It's going to cost more for mergers and acquisitions. I think it's going to impact the balance sheets of a huge amount of American corporations as their borrowing costs go up. And they're talking about 0.5 point increases well into the future. And this is going to be a negative, in my opinion, on the equity market and on the bond market. So you've got both markets moving in the same direction, which is down in price. I think we'll have some moves like today where, we move back up, but I'm not optimistic about where we're headed. And then hopefully we don't go into some recession, which the Fed has done to us before. It's a very, I think, difficult time, which is why I suggest income plays as a safe strategy versus trying to bet on higher prices in equities. And we're certainly not going to have higher prices in bonds at this point, in my opinion.
Mark, when do you think enough damage will have been done? What will be the sign that, okay, we know that these are more difficult times, but the market has baked this in? What will be the signal to you that that's happened?
The signal is going to be the Fed when they say they're going to slow down on raising rates, when they're going to slow down on cutting their balance sheet. And of course, I have to be fair about this. It's not just the Fed. If the administration would take a different viewpoint and start pumping oil and open the pipelines and so forth, would also affect inflation in a very positive manner, in my opinion. We could also ship oil and natural gas to Europe and effectively help bankrupt or slow down Russia. We would be adding more jobs in the United States. And the idea of this Green New Deal is fine, but it's something way off in the future. In the meantime, we have immediate problems that we should be dealing with, and we're not.
I don't think I've heard you sound this pessimistic in a long time, and I know that you have not liked the bond market for a while. When was the last time you felt like this?
When the bond market yields more than the inflation rate, I think bonds are a good place to put money. But the bond market, even after dropping significantly since the beginning of the year, is nowhere near the inflation rate. If you take the average of the CPI and the PPI, it's around 9.25%, which is, I think, the best measure of what our inflation rate is, and bonds are nowhere near that. And if you can't beat 9.25% depreciation plays, you have to look for other strategies, which is why I invented this income strategy, which is paying more than the inflation rate. And you do get money every month. And I just think that play is the best play for the moment. And it's, I think, safe. And, you have to move. I've been in market, as you know, Becky, more than 40 years. And you have to change strategies from time to time if you want to win the game. And I always want to win at the game.
Shepard Smith here. Thanks for watching CNBC on YouTube.